What does a bank actually do with your money once you put it in there?
A bank is more of an airport than a storage locker.
When do you see people needing a cash management platform over and above what they get from a normal bank account?
We tend to find that it's when cash balances start to become more material.
Because we do have in the UK a big problem with underinvestment, where for the long run, people don't invest enough, don't take enough risk and don't get the return. So what you're describing really is there's day-to-day banking with your current account and your savings account. There's investing where you definitely want that to be for the long run and that you're happy that the markets can go up and down. And in the middle is this notion of doing more with your cash.
If you think about cash as being in different layers rather than just in one giant pile, then you can think around what are each of those layers there to do.
Welcome back to the Funkle Pod, everybody, where we cover the money topics you didn't learn about in school with expert guests, and it's always jargon free. Today, we're talking banks, how they work, how to think about savings properly, and when a standard bank account isn't enough anymore. And our guest today is none other than Dr. Emma Black, co-founder of Cascade, a cash management platform that helps people and businesses make better decisions with their money. And previously, the co-founder of GB Bank, a UK challenger bank. So Emma has built banks from the inside, which means she understands exactly how your money is treated once it lands in an account and where the opportunities and the traps are that are out there. Emma, welcome to the Funkle Pod.
Thank you so much for having me. Really excited to be here.
Fantastic. The first thing I'm going to call out, Emma, is you're from Durham. You don't look and sound like what many people think a banker looks like. How did you end up founding a bank and founding a cash platform?
I know it's been a crazy journey, to be fair, and one that has involved taking advantage of opportunity as it's appeared, really. I've always had a passion for numbers and quantitative side of things. As a child, I would role play being a cashier in a bank. That's how fun I was growing up. But it was one that actually going through that journey to then end up launching a bank. It wasn't a planned thing, but it was very much spotting things that aren't working very well in the market and thinking of ways in which we can try to make them work better. And we started that by first off looking at a financial advice company and really gaining an understanding from clients around the challenges that they were facing in terms of navigating that market, some of the frictions that were there in being able to get good outcomes for their cash and their money. And then we started to slowly build different things, different tools that would help us to be able to fix that for them. And as that continued to grow, we started to have more financial advisors in our network that also wanted to use that for those clients and their own clients. And as that started to develop, we then started to build kind of businesses within businesses. And ultimately where we got to is we had tools for direct lending for people that were suffering with getting access to capital. It's a real challenge within the market now of computer says no from the banks. And also we were getting people that, had money sat current account earning absolutely nothing. And we had our savings tool, which grew into Cascade, to be able to give people an insight into all of the different types of banks that are there, the thousands of products that they have on offer, and a bit of guidance around how do I choose, how do I navigate this environment on my own. And really that led us to GB Bank because we seen an opportunity for what we felt was a new kind of bank, a bank that was treating its customers fairly, that was offering rates on savings that were competitive, which the team that are running the bank today still do, which is great, and being able to try and level that playing field somewhat on the development finance aspect as well for SMEs. So it's been a fantastic journey and delighted to be on the podcast today. It's a real passion of mine to try to hear from people around the stuff that's causing them problems, anxiety, or things that they're struggling to navigate and work with people like yourself, Dan, and others that are trying to simplify that landscape.
So At Funkle, one of the things we're keen on is making sure that we're focusing in on the things that people didn't necessarily learn at school, the topics that that everybody assumes that everybody knows about in life, because most people have got a bank account, but ultimately most people don't actually know how they work in practice. So give us an insight from the inside. What does a bank actually do with your money once you put it in there? Because it's not actually sitting in let's say you've deposited £1,000 in a bank account. That £1,000 isn't actually sitting there, is it?
Absolutely. So I think in terms of understanding how banks work, it's a really important point. And it is one that, for those of us that know, it's a very simple one. But if you don't know and you've never been told that, then sometimes it can be an abstract concept. So for us, in terms of a bank isn't somewhere that is just holding your money in a vault, and it's not physically holding that money in a vault either. A bank is taking money in and they're using that money in order to become a source of lending and investing on behalf of the investors that ultimately own that bank. A bank is a business. So when you deposit £1,000 into a bank, in your current account or in a savings account, the bank will often keep a small proportion of that, and they'll keep that available for when you want to spend or you want to make withdrawals. And the rest will then be used to issue mortgages. So when people are buying a house, or when a business is looking to buy commercial property, they'll use it for issuing business loans. They'll use it for credit cards. They'll use it for investments, for financing projects, a whole range of things. So the money that you deposit, the bank keeps a proportion to make sure that they have enough that's accessible for all of their customers, day-to-day spending, etc. The rest of it will move through the economy. And it will move through the economy in terms of different products such as mortgages and credit cards and lending. So a good concept to think about that would be thinking about a bank is more of an airport than a storage locker. You come into the airport, you leave the airport. And all those things, instead of you just going there and you're storing something and it doesn't move anywhere, that money is flowing through the system, flowing through the economy from bank to bank through a variety of different transactions. Now, going back to the bank being a business, the bank is a business and it's there profit making. It's there to make money. And how does the bank make money in that regard? Well, the bank is making money primarily through the money that it will pay the person depositing, so the saver, and the money that it takes in from the people that they are lending the money to, the borrower. And the difference between that is where the bank is making its profit. So a bank might pay you nothing in your current account. They might pay you 1%, 2%, 3% on your savings account. They aren't lending money ever for free. They will always be charging a borrower, and say they're charging a borrower, 5% on a mortgage or 6-7% for a commercial borrower. The difference between those figures is where the bank is making its money.
And there'd be this concept throughout modern history, anyway, of the run on the bank, from maybe from the Great Depression, maybe from 2008. Where we saw it with Northern Rock, or for some people, and certainly in my household, it might have come from Mary Poppins, where they have the run on the bank in that as well. But this is the idea where your idea of it being an airport, not storage locker, is that if everybody goes to try and get their money out at the same time, it's not all sitting there in the storage locker for everybody to be able to take it out. Some of it's been used elsewhere, which is why it's important that everybody continually has faith, isn't it, in the concept of the bank. Because if everybody goes to take their £1,000 out all at the same time, everybody's £1,000 have been deployed doing other stuff, haven't they?
Absolutely. And I think that's a really important point. And people might have heard about something called the Financial Services Compensation Scheme, the FSCS. And that's something that when you go into your bank, they might tell you about. And what that means is that's almost an insurance contract. And that's to try to ease concerns about things like the run on the bank. Coming from the Northeast, we have lots of people that were very, it was very close in memory, the Northern Rock situation. And you're absolutely right, Dan, that's a lot of customers altogether deciding to go and take out more money than the bank's actually holding liquid at that point in time, i.e. accessible. So the Financial Services Compensation Scheme, which today will protect each individual person up to £120,000 per banking licence. And if you are married and you're a joint couple, then that would be up to £240,000 per banking licence. And that's designed to give people also that faith and confidence. So really, in terms of any run on the bank, that financial services compensation scheme should give a lot of people confidence that the bank is highly regulated. You've got regulators that are looking after the providers to make sure that their reserves are enough for dealing with day-to-day spending and withdrawals and all of those different complicated types of things. But also what you have is then a backup as a consumer, as somebody that's using the banks, so that if you are in a position that you've got 120,000 less or 240,000 or less on any banking licence, then you'll have that FSCS protection. That's designed to give you that confidence.
And important as well, given that people can place their money in, know that even in the worst case scenario, it's covered. Government's going to step in, as they did back in 2008.
Yeah, and I think for us, my day-to-day is spent with people that are in a fortunate position of having more than those limits in any one banking provider, and they're having to navigate having different accounts with different providers to make sure that they too can feel safe. And for those that have smaller balances and maybe are building those balances up or thinking about how to get their money working for them in the best possible way, the FSCS scheme should give you the confidence that in the worst case scenario, a bank unexpectedly does get into difficulty, the buffers that they have to hold to keep the regulators happy would then come into force. And in the scenario that they run through those and they're really in a difficult position, then absolutely you've got the FSCS to also give you confidence and safety. And you would also be in a position that naturally for something that was going to cause systemic risk to the economy. And what we mean by that is it was going to have an impact that was going to be quite significant to all businesses and all households. Then the regulators would step in with the government to try to figure out the best way to navigate that. Ultimately, as a consumer that is holding money, I think one of the key things for me and key messages from today would be for you to take ownership and responsibility of that and use the resources from Get Funkled and other places to be able to find out, what's the best place for me to have my money, where should I be navigating it, because ultimately these are businesses. And ultimately, the businesses can do really well. Sometimes they can do not so well, and making sure that you take advantage of things like the FSCS and you do shop around and you know how to shop around, I think is the key thing for making sure that you give yourself the best opportunity to get a really good outcome.
And when it comes to shopping around, and we've got some modules on this on Funkled about the different types of account, but it may be for some people, they look at it and they think, well, a bank account is a bank account is a bank account. But you've got current accounts and deposit accounts and savings accounts, and then you've got all the ones with fancy names and come in with a black card or a platinum card and all of those types of things. Break down for us what's the reality of what it is that you're getting when it comes to these different types of bank account ultimately.
Absolutely. So there are lots of different products and, lots of different things that are out there for people. So yeah, you're quite right. Most people will have a current account. The current accounts are what we call technically payment accounts, and they're there to make a series of payments. You will be able to set up direct debit, standing orders, and those types of things from those accounts. They're designed for convenience. Most people will use a current account for day-to-day spending, for bills, for getting paid from their work, for easy access to money unexpectedly. And what a current account is there to do is it's there to prioritize speed, access, and simplicity. It's not there as a design to give you growth or a return. Really interestingly, in many other countries, you are charged for holding a current account. Typically in the UK, you aren't. Businesses tend to be, charities sometimes are as well, but most individual households won't be charged for their current account. You're quite right in terms of where you do sometimes pay a fee for a current account and you get a special card or you get a premier access to something that will usually be based upon the level of transactions that are coming in and out and the value of those. And you will pay a monthly fee, and that monthly fee will give you access to a series of rewards and maybe some exclusive offers. So you might be able to get cash back, you might be able to get cheaper access to things such as, tickets to Legoland or whatever it might be, and that will become part of that monthly fee. In terms of a savings account, so a savings account is designed to encourage you to save and keep a good financial reserve. They will pay you some interest on it. Usually, they will reduce the level of impulse spending that you might have. So if you've got a high current account balance, you might be more inclined to take that extra trip to Costa or that extra trip to Starbucks than actually if you've saved, you've popped the money into a different pot and you've got a budget for what you want to have for your day-to-day spending within that month. In terms of the savings accounts that are there, there's lots of different terms that are on access. So you can have an instant access savings account, which will often allow for you to get access to that money on a day-to-day basis. And you can also lock some of that money away. So you can tell the bank that actually, I don't need that money. I don't want to touch that money. So I'd like that to go away, and I'd like it to go away for a year. And the bank will pay you an interest rate and will lock that away for you so you don't have access to it. The key thing is in terms of where does the value really sit for people? Well, cash is often useful for you in terms of being able to fuel your day-to-day transactions, in terms of what your spending is there to do. But the long-term value of that cash is often built elsewhere. And that comes through the savings accounts, putting that into a separate pot, into a separate home, that you can sometimes also give a savings goal into that different pot for whatever it is that you're parking that money for, whether that be a rainy day or whether that be, a holiday or a wedding or whatever that is. You can have your different savings pots and mentally that allows for you to try to make sure that you still get that flexibility that you need in terms of being able to pay for what you need and want to pay for, but you also make sure that that money is being more productive for you. And a key message is that often sitting in a current account, it's usually not very productive at all.
This is a key area that we focus in on a lot at Funkled, is the psychology behind the decisions that we make with money. And often it's very real, raw human emotions that make us end up making the wrong decision. Because of, it can be fear, it can be greed, it can be envy, it can be want, it can be desires, but there are all these real emotions that come into play that mean that the rational thing doesn't always end up happening. Being quite intentional with bank accounts and savings accounts is something that a lot of people miss out on, isn't it? And you've just touched on that there, which is, I'm going to have a very clear intent for what this account is used for. And I'm going to have a very clear intent for what I'm going to do with that money and where it's going to go. And there's this concept of paying yourself first out of any money that's coming in from a salary or however you're earning your money. And then, right, I know that I'm paying myself first and this money is going to this savings account, or I would even argue, even better, this investment account, in order to avoid that idle money concept. What do you think that the overall the UK banking system kind of benefits from an apathy and an idle approach to people's cash? Should we be moving an awful lot more than we are?
I think it's a really important point that you mentioned in there, Dan. I think the reality is we know that the financial system is working to a degree for the consumers and the users that are there. But we also are well aware that there are lots of frictions. Some of those frictions are there because we have to make sure that we keep people safe. And some of those frictions are there because we are dealing with for-profit businesses. And it's a real hard balance to actually strike which category some of the processes is fitting more into. For me, I think I'm really around financial empowerment. And I think that comes through from three core areas. One, financial inclusion. So being able to include people more into the system. We've both made the point that most people have a current account, but not everybody. I think that's a real important point for people to get. The second one is around financial literacy, which is such a passion of both of ours and obviously a huge motivating force for Get Funkled, which is making sure people have the financial understanding to know the different products that are there, how things work, why they're working in that way. And I think the greater the education that we have on that, the greater the education, the simpler things appear and seem. And that can also help us to simplify the process and simplify the system for people. And then the third thing is also financial confidence. We were part of a parliamentary programme to make sure that financial education was coming into the curriculum within schools, which I'm delighted to see that it is from 2027 spring. And, you know, it's a door opener, it's a starting point is the key thing. But in terms of that research, we went through and 50% of adults at that point had said that they don't feel confident in managing their money on a daily basis. A third of adults had said that even thinking about the financial situation was something that caused them anxiety. And when we look at those that are most likely to feel most worried by that, 50% of young people aged 18 to 34 said that they were most likely to feel worried. 48% of parents reported feeling worried about their money, and 51% of private renters. Now, I'm sure some of our audience will fit into those categories, and I think you know, the more that we can look to empower our education, our understanding, our knowledge, the tooling that we have available, and our awareness of that tooling, the more things will appear more simple than what they presently feel today. And when you think around then some of the things that we can do to organise ourselves and to be aware of those psychological heuristics that are there in terms of how we approach money and spend money, then that can also give us a bit of an advantage as well. So one of the things in my academic days and years gone by in terms of research was looking at some of the different characteristics and traits that we know are there for us as humans. So, for example, if you receive money from your salary, you are more likely to prioritise paying your bills, paying all of your necessary spending with that money. You are less likely to be frivolous with that money. If, however, you win some money on the lottery or the postcode lottery or whatever it might be, you are more likely to spend that money on non-necessary spends than, you know, going on a holiday or new cars or things like that, and you are more likely to be less careful with it. Whereas actually, that money should be treated in exactly the same way. If you organise it correctly, that adds into your pot. If you get your money working more productively for you, it helps to ease your load on an ongoing basis. So if you continue to organise yourself in a good way, that, you know, if you do get a lottery win or unexpected cash and whatever it is, and you put some of that into your rainy day pot, some of that into your retirement pot, some of that, you know, into then your holiday pot, you know, and things like that, then what you do is you make sure that you have some benefit from all of it, rather than a quick spend, it's gone, and then you're left in the same position. Ultimately,
that's really interesting.
Whenever we make a transaction, we're giving our money to somebody else.
That's really interesting that a pound doesn't know where it came from, does it? And yet it seems as though psychologically people will deal with a pound that they earned differently from a pound that was given to them, whether that's, you know, inheritance or as you say, a win, or even, and you'll see, you see this a lot. For example, you go to the races. Let's say somebody wins at the races unexpectedly. And they're like, well, I've just won this money. I didn't have that before, so I might as well splash that. As opposed to, well, that pound is exactly the same as that pound that I just earned. It's weird how the intent about what we will and won't do with it differs based on where it came from.
Absolutely. And I think the more that we're aware of our propensity to be victim to those types of choices that we will make, the more that we can control that, because we are human, and we work so hard. We live in a society that people are working very hard, and often you'll hear people that, might have lots of money and say, oh, it's just about working hard. And well, that's not true, because there are people that don't have a lot of money and they're working exceptionally hard. Often it comes into not necessarily what we earn. It comes into how good we are at organising our money and how good we are at making that productive and making healthy choices for ourselves in terms of the areas that we're spending it on. And there's a great thing in terms of, there's some pamphlets from years and years ago from the 20s, from The Richest Man in Babylon. It goes through various different things around, when you get money in and how you should allocate it and spend it, and ultimately make sure that you're enjoying your money as well, because you do work for that purpose, but actually making sure that you have it organized and you have it productive, and you are being mindful of the spend and the choices that you're making. I think that's a really good starting point to just reflect. And I challenge myself on this all the time. I challenge myself that every time I go to the train station, I get that, the hot chocolate or whatever it is, and and it's kind of, now you're talking around £5 at a Costa or a Starbucks for a hot chocolate. And that can add up for people. That can add up if you're doing that on a day-to-day basis, and you're getting a coffee on the go as opposed to taking your lunch in or things like that. It's where do you value that money going? How much do you value what you're spending and what you're buying? And if it's up to you, that's subjective. But if you are really valuing that and you can afford that, that's great. But if you find that you're getting to the end of each month and things are tight and you think, I'm again struggling in terms of being able to meet things, think around, where you're choosing to spend your money. Are you choosing to, go to Aldi, Lidl, etc., versus some of the more expensive supermarkets, the Waitrose, and different things like that? The choices that you're making, the cars that you buy, all those things, in real terms, as you earn more or as you get money, if you spend more, you're not in any better position.
And that intentionality of what you do with the money, it starts early, or if it starts early, you can run that through continuously. And one of the key steps that I see people taking who express real confidence in money is they're paying themselves first, but then they know what's left, as opposed to the other way around. Whereas you see a lot of people struggling with bank accounts and overdrafts where they're saying, right, well, I will save what's left after I've spent, rather than I will spend what's left after I've saved. And that key distinction of having an understanding of what each of your bank accounts does and where you're going to point that money and the order of using it in that way helps a great deal. When do you see a normal bank account, so a current account and a savings account, when does that stop being enough? Which are the tipping points in life, the life stages where you're finding that people look for saving strategies beyond a current account and a savings account?
Absolutely. And I think a key message on this one is it's very subjective. So part of the financial understanding is we all process risk in different ways. So some of us absolutely love it, embrace it, and are happy to try new things, and some of us aren't. And I think dealing with your money, it's no different. So my guidance would always be to start slowly and gradually, and make sure that you are gaining your financial understanding and your confidence as a result of that understanding before you think about doing something that takes you too far as such. So the first thing for me would always be, if you've got money sat in a current account and it's not productive for you, it's not in any interest, the first step would be, let's think about a savings account. So today you can get, for example, over 4.5% on instant access. In that's from a well-known provider, Chase Bank. And you can get cash back on that, in terms of a current account with Chase Bank, and you can get a linked boosted savings account for 12 months, which will pay you 4.5%. So in the first instance, challenge yourself, think around opening up a new account with a new provider you might not have heard of, get your confidence in that regard. When you do so, make sure that you check all of the information related to them. They're regulated and you've gone through that. Then think about getting a savings account and getting more on your savings. Now, when you go through that, you'll be thinking then around those organisation elements that we've discussed there, around the different pots. So think around how you want to manage it. And you're absolutely right, Dan, as well. Think around how much you want to be saving, you need to be saving. And then budget your day-to-day spending on what's left. And that can then help you to decide, do I want to go for that daily coffee? Do I want to take that taxi instead of the tube, or walking, or whatever it is? That helps you to make those choices. And often what I do periodically is I will also look at my spending to see where I've been spending money, and actually ask myself, was that the right spend? Did I get a lot of value out of that? So those things are kind of a starting point to get yourself used to that. Now, as you then evolve beyond that, then you get into a new range of products. And there might be products that are available that can help in terms of some tax efficiency. So things such as individual savings accounts, the ISAs, that you can get some tax benefits. Pensions, you can get tax benefits when you're making contributions into your pension as well. Where you can push certain income tax levels to later, defer them until later in your life when your income might be lower than it is today. So you can also then look at those types of products, and they help you to plan for being able to see, how much do I need today? How much might I need tomorrow at a different point in my life? And those are useful things to then think about considering. And then if you're in a position that you can go beyond that, then there's a whole range of products that are there. And at that point, it does become useful to speak to an advisor or speak to somebody that is well skilled in that area, even as if you have an initial review meetings, to make sure that you understand how your financial setup is evolving and changing, and making sure that it's continuing to work for you. I think the key thing for me is that you shouldn't necessarily wait to do any of that for a certain moment. You shouldn't necessarily be waiting for the tipping point of, once I reach a certain level of income, once I reach a certain life stage, I'll think about this. Actually, no. The sooner that we start building those habits, the greater the benefit it will be for us, both in terms of the financial reward and in terms of that psychological shift. Knowing that we're organised, knowing that we've thought about those things, knowing that we're planning, we're making active choices in where that money is and what it's going to do. Then when we do have life stage changes, and we go from being a single individual to being in a joint couple, to being a parent or whatever that may be, or to be becoming a carer for parents, we're actually planned and prepared, and we know exactly what we can do and what we can't do. So when we do find ourselves in positions that we have to emotionally make decisions, We've already structured what is possible to us and what isn't. And I think the reason that, the sooner that we start thinking about this, the better, is because it comes back to that point of, it doesn't necessarily matter how much you're earning. It matters around how you're managing and organising that money and spending it, and being aware of key concepts such as inflation. That the value of money today is different. Everyone that's listening, in the last 5 years, we've had a real problem with inflation. There's been a lot of media coverage around it around the world, not just here in the UK. We've also had a lot of change in terms of tax. That's been a big change as well. Those types of things are concepts to also be aware of, in terms of, your money might not be worth the same tomorrow as it is today. So actually not waiting for a tipping point, not waiting for a certain level of income or a certain life stage, or just actually implementing this for ourselves today, I think is a real important message, because all of these things matter. It matters to be protected with insurance. It matters to make sure that your money is being productive for you, to lessen the load in terms of what you're having to do working wise day in, day out, to understand that the choices we make in terms of where we choose to spend money, give it away to another business, another person, company, that's going to reduce our ability to spend that tomorrow, and reduce the impulsivity of things into, actually, this is a planned for spend, a planned for investment, a planned for choice. All of that will be something that actually can enable us to, get to a better financial outcome for ourselves.
That notion that I'll deal with it when, or that'll be important at this point, it is one of it's one of those human traits that we really need to get people to address, don't we? Which is that, no, you should be considering all of this, irrespective of whether or not you are about to retire, about to get married, about to set up a business. If you've dealt with all of these things long before those big decisions come along, life becomes an awful lot easier.
It really does.
Having those processes set up. What do you see? You've established a cash platform, a cash management platform. When do you see people needing a cash management platform over and above what they get from a normal bank account? What are the trigger points that take people from current account and bank account and savings account, to cash management service?
Absolutely. So for us, in terms of our experience, we tend to find that it's when cash balances start to become more material. So people will go through different life events, and there might be divorces, there might be inheritance, there might be bonuses from work, or you're accumulating a good savings amount month by month. That actually this becomes something that you're aware, I should be doing more of this, I should be looking at this more. I do want to make sure that for people that are listening that don't have that level of balance, it's still important to shop around, and it's still important to look at getting better savings and looking at cashback, because that can help you to build your money. But for us, we tend to find that it's when people are going through different stages of their life that they end up having more cash than normal. Sometimes they can be going through a psychological shift as a result of that. So sometimes, if it's inheritance, the bereavement process, and it can, we might not want to make decisions there and then around what we want to do. We also see a number of times, within the UK today, one of the biggest causes of death, very sadly, is Alzheimer's. And we see a number of family members that are trusted as attorneys or deputies to look after somebody else's money. And sometimes as a result of that, the Alzheimer's progresses where they need to be moving into a care home, which can result in property being sold. And again, large cash balances. And sometimes the amount of money that comes from that can be more than somebody is used to looking after, which can also trigger, actually, we need to think about this. And really,
people will be able, by the way, Emma, people will be able to find an episode of the Funkle Pod that we've done with Jacqueline Berry from My Care Consultant, where she gets really stuck into the different ways in which care can be paid for and the strategies that come with it. And so if people are looking for further detail on that, but you're absolutely right, making sure that there is a strategy there and utilising the home of the person who is in care is obviously one of the biggest ways of doing that.
Absolutely.
I interject.
Absolutely. And I think really what we're seeing is when cash stops being transactional and starts becoming material, so we don't expect for the money to come in and go and pay our mortgage or things like that, I think that's when we should be triggering to think around what we should be doing with it. And my immediate thing for people is always to say it, and especially today, interest rates have rebounded back to long-term historical norms. As I say, you can get 4.5% on instant access. You won't be getting that in your current account. So today there is a real reward for taking the time to move that money around, and I think making sure that the money stops sitting as pocket money or spending money, or it's and actually it's starting to become larger, and it's starting to sit there. Then psychologically, people should be saying to themselves, I probably shouldn't just leave this sitting here doing nothing. I probably need to start thinking more intentionally around what to do with this level of cash, and there will be risks as part of that process that people might not have considered before. And I think that's where doing it yourself is one option. And then also lots of different platforms and tooling that's there to be able to very quickly, see what products could become available with, processes that should be simplified, and with humans that should be available to also ask questions that you should never feel scared about asking. It's really important to ask a question and to clarify something that you might not know. So I think those types of things for me is when you start to have balances that are more meaningful from whatever that situation, then I think that, and it's not day-to-day transactional stuff, I think that should be it as well. And I'm a big proponent of planning today so that, those structures are in place, because where you find yourself in an emotionally difficult position that you are selling somebody's home, because they're going into care or those types of things, you're not overloading yourself mentally with then having to deal with things that structurally we could have put in place for ourselves many years ago as such.
It's interesting that the scenarios that you're painting are nearly all ones where there's extra cash than people would normally be expecting or normally are dealing with, but also where that cash is potentially needed. Because we do have in the UK a big problem with underinvestment, where for the long run, people don't invest enough, don't take enough risk, and don't get the returns that come from being exposed to investments which grow on the whole over time more than cash deposits do, albeit they can go down as well as up, and that's the trade-off. So what you're describing really is it that there's day-to-day banking with your current account and your savings account. There's investing, where you definitely want that to be for the long run and that you're happy that the markets can go up and down. And in the middle is this notion of doing more with your cash that's not the day-to-day. But again, you don't want it at the whims of the ups and downs of the market. And that's where you're talking about things like, I've inherited some money, but I don't know what to do with it yet because maybe I'm grieving, or mum wouldn't want me to frivolously waste this money. Again, it's all of the human emotions again, isn't it? Rather than the practicalities of money. There's a relative in care and we've sold their house. Well, we need that money to be able to pay for their care. We can't go and invest it for the long run. So these are the scenarios where you think a sort of a layering approach to cash and I guess a more complex approach to cash than just having a deposit and a savings account benefits people.
Absolutely. And I think the layering mindset is absolutely, important for people to try to move their mindset away from, all my money sits in one place. By default, I've got it in one pot and I know where I am and I know what I'm doing, into actually different money can do different jobs for us. And we can have different pots, a savings pot, or have different pots that do different things around investment pots or whatever it is. But we can also think around the different things that we need money to support us on in terms of our lives. So some money needs to be instant access. We do need some for day-to-day spending, and we do need to pay our bills. Some of our money needs to be used to help to protect us, both now and in the future, in scenarios that we don't know what might happen. We need some of our money to grow for us. And the more that we get our money growing for us, the more that we build how much we can spend tomorrow compared to what we can spend today. And some of it just needs to have a clear purpose. It just needs to be organised. It needs to be put in the right place, doing the right thing. So if you think about cash as being in different layers rather than just in one giant pile, then you can think around what are each of those layers there to do. So if you think about the first one around access, I'm going to use that for, paying my bills, my day-to-day spending, emergencies. We all have those situations. I had one recently. I'm driving a pothole. £90 to get the tyre, the wheel replaced, things like that in terms of, just daily life. And the point of that layer is it's easy reach, it's easy access, and what you want to do with that layer is you want to be prioritizing convenience, speed, flexibility, and that's okay. And then you might have another layer which you say, okay, I want to have a layer that is around protection. And what do I want that layer to do? I want that layer to give me stability, reassurance, resilience. I want it to be a cash buffer for me for when things unexpected might occur. And you might have a rainy day savings pot. You might have emergency savings there. You might have a pot set aside for paying a tax bill in your self-assessment. You might have a pot for unexpected costs. You might have pots for Christmases and birthdays. And making sure that you're budgeting and allocating a spend there. And this money in that layer is there to reduce your stress. So you've got protection in terms of unexpected costs. And also, of course, you could spend that in terms of insurance products. So making sure that you're buying policies that can protect you in the situation something goes wrong with your house, with your car. Something goes wrong in terms of your income, your health. Then you might have another layer that is designed to help you to grow your money. And the objective of that is that you want it to get a good return. So when you've allocated some money to go into that pot, then you do want to look for products that are going to maximize that return. And you're absolutely spot on that in terms of that, one of the core objectives for the financial regulator in the last couple of years is around underinvestment. We do recognise that we have an unhealthy approach to risk within the UK. Risk is something that we avoid, and yet it's something that is part of our day-to-day lives. Risk is a danger, but it's also an opportunity. It's a chance to get an upside as much as a downside. And what we should be doing is assessing the choices that we're making and trying to give ourselves the best possible opportunity to get more of an upside than the downside on it. And investing and making use of different tools that are available, both on an amateur level and just getting yourself going and getting your awareness into a more sophisticated level, is something that can allow you to help in that layer grow money over time, keep pace or outpace inflation, so that the real value of your money, what you can buy with it, maintains or grows over time. And also money that helps you to support future goals and allow you to reduce the load at a later point in time. And then you can also have, layers in terms of emotional layers. You can have things that are there related to house deposits, related to your children, related to travel, retirement, and all those different types of things. And when you organize your money and you think about what you need from it, from an access perspective, and you think about what you want from it in terms of reassurance or resilience or growth or whatever that is, that's a really important point, because then that gives you clarity around where you need to look in the market to find the right home, to find the right destination for where that money should be sat and what it should be doing and how it should meet those objectives for you.
Now, Emma, in closing, I always ask the same question of everybody coming on the Funkle Pod. What do you know about money now that you wish you'd known sooner?
Absolutely. I mean, for me, as ever, I wish I'd started sooner than I did. And I think everybody would say that. I think. You
mean saving?
Just in general. I think in general, organising my money, thinking about the different types of products that are there and the different types of investments. And I certainly wish that I'd started sooner before kids, because I think the later that you get on in your life, the greater the demand that's there.
Expensive little blighters, aren't they?
They are. But it comes on, I think, starting sooner rather than later is a real key thing for me. And I think in terms of the call to action, I really think a lot of things for us in life come down to organisation, time management and record keeping. Making sure we organise what we want from our money, what we're wanting it to do, and we make sure that we're contributing to all of those things and holding ourselves to account on a discipline level of, the choices that we make and reflecting that. Time management wise, are we given enough time to make sure that we are getting good outcomes from this? Do we regularly schedule in a review of ourselves or with somebody that has got the knowledge and the skills to help me, and go through that on the basis and record keeping? One of the other things is, as you go through, the older you get, you realize how important it is to just keep that central record for yourself. What's your money doing? What is it doing? How much do you have? What's it expected to do? Who do you need to speak to? And all of those things can be really, really important, because you just don't know what might happen. And where you have family members that might be looking after things for you or things like that, having it just really clear for both yourself and for them, I think is probably the biggest thing for me. So I think just organising your money, giving the right amount of time to it, keeping the right records, and then naturally growing your knowledge, which will in turn grow your confidence, I think are things that will undoubtedly lead you to get better outcomes.
My biggest takeaway from this conversation is that banks are predominantly just a tool, and tools only really work well if you know how to use them, and you're using them with intentionality, with an aim in mind, and this notion of making sure that we're using them to achieve the right outcome, that we're layering in the right use of the right bank account for the right job, and then knowing when it is that we're moving things away from a bank account and into other things like investment or insurance and all the other things that we need in order to achieve the financial outcomes that we want. So if this episode's made you rethink about where your cash sits and about your money system as a whole, then share, or somebody who might need that, then share this with them. If you're doing fine with money but you haven't really assessed it and looked under the hood, maybe there's some ideas in here of things that you should be getting stuck into. Remember, Funkle's a financial education platform. We don't give financial advice or make personal recommendations, but there are plenty of tools and learning modules on all these topics on the site, from different banking strategies, the difference between different account types, and when you might want to think about investing rather than saving. So if you need to, get Funkled, and we'll see you next time. Emma, Thank you very much indeed.